The world of global trade just got a seismic jolt, and it's coming straight out of Washington. President Trump has dropped the bombshell, signing an executive order that slaps a hefty 35% tariff on every single Canadian import starting August 1st. Barely catching their breath, he followed up with a threat to hit Mexico and the entire European Union with a 30% tariff wall, also set to kick in next month. The ink's barely dry on these decrees, and the fallout is already rippling. In just 48 trading hours, Wall Street's tech giants, the so-called Magnificent Seven, saw $2 trillion in market value vanish like smoke. Reuters is calling it a midnight tariff blitz, a move that's got Canada, Mexico, and Europe scrambling to rewrite the rules of trade. But this isn't just about numbers on a customs form. This is a high-stakes chess game, and the board is shifting fast. Let's talk about the Northern Corridor, a $120 billion steel lifeline that's got everyone's attention. This isn't some dusty blueprint, it's real. With concrete pouring in Prince Rupert and rebar bending in Tampico, the plan is audacious. A rail and port network stretching from Canada's Pacific coast to a shiny new Gulf terminal in Mexico, tied together by the newly merged CPKC rail line and a blockchain customs system that clears cargo in minutes. Freight insiders say this corridor could siphon off half the $104.28 billion in monthly trade that currently rolls through U.S. highways and ports. That's not pocket change. It's a gut punch to American supply chains. If even half that freight skips U.S. soil, the Treasury could lose $70 billion a month in customs revenue. That's more than Alaska's entire GDP, gone before the leaves fall. The stakes are crystal clear. Canada and Mexico aren't just talking, they're moving. On July 16th, Mexico's President Claudia Sheinbaum and Canada's Prime Minister Mark Carney hopped on a call to fast-track a bilateral trade deal aiming to sign before the year's out. Every mile of track laid locks in a new supply chain reality. Insurers are rewriting risk models. Bond traders are slashing forecasts for U.S. ports like Long Beach, and factory managers in Detroit are staring at contracts that might vanish south to Veracruz on a tariff-free train. This isn't a hypothetical anymore. The Northern Corridor is a machine coming to life, and it's built to dodge Trump's tariff hammer. Washington's response? Crank the pressure to 11. Trump's July 10th order targets Canadian goods with a flat 35% hit, everything from steel slabs to engine blocks. 2 days later, he warned Mexico of a 30% levy if trade talks tank. The deadline for both is August 1st, leaving America's neighbors with weeks to decide whether to fold or fight. The fine print is ruthless. Steel, transmissions, and auto parts face the full tariff, while separate duties, 50% on raw metals, 25% on finished cars, stay in play. Ottawa's calling it economic blackmail. Mexico City says it's colonial déjà vu. Markets are jittery, half expecting a last-minute deal. But the currency markets aren't waiting for handshakes. The Canadian dollar took a quarter-point dive within hours of the announcement, its worst day in a month. The Mexican peso followed, shedding nearly 0.5% by Monday as traders braced for pricier U.S. imports. Those small currency dips add up fast. In a $1 trillion foreign exchange market, they signal billions in lost purchasing power for factories buying U.S. machinery, chips, or soybeans. Every cent lower inflates costs, feeding the very inflation Trump's promised to tame. Supply chain bosses are already rerouting shipments, knowing a gearbox that skips a 35% tariff could mean the difference between profit and layoffs. The longer this standoff drags, the more permanent those detours become. Banks from Toronto to Monterey are stress testing for recessions, while lobbyists swarm Capitol Hill with desperate pleas. Trump's team, though, is betting on a late-night phone call and a face-saving compromise before trucks hit the border. But August 1st isn't a suggestion. It's a deadline carved in stone. Now, let's zoom in on the Northern Corridor's steel spine. This $120 billion beast links Prince Rupert's Pacific megaport to a new Gulf terminal outside Tampico, powered by CPKC's rail network. It's not just fast, it's a game-changer. Trial runs by Schneider show Mexico to Chicago shipments dropping from 7 days to 4. That's 3 days shaved off, bypassing Los Angeles entirely. Canada's also swapping paper for code, with a blockchain customs system that cuts export paperwork from 3 days to 4 hours. Added up, And the math gets brutal for U.S. ports. A train that clears customs on the move and hits the Midwest 72 hours faster doesn't just dodge tariffs. It rewrites contracts, inventory plans, and factory schedules. Ports from Seattle to Savannah are staring at a future with fewer containers, and the ripple effect is already hitting. Prince Rupert's cranes are gearing up for the overflow, backed by new rail sidings and a blockchain-ready yard that stamps clearance before containers even open. CPKC is doubling down, laying a second Rio Grande bridge and promising twice the train frequency the moment tariffs hit. The capital's spent, the tracks are welded, and the software's live. All it takes is that first tariff notice, and the freight will move itself. If you think this is a bluff, watch the next container roll past Detroit without stopping. The Treasury's counting on $69 billion in customs duties this year, but if half the Canada-Mexico trade shifts to this corridor, that cash dries up fast. Ports, warehouses, and Midwest factories, employing 31 million Americans and driving $5.4 trillion in GDP, feel the squeeze. Every box that clears Prince Rupert instead of Long Beach pulls a thread from that economic fabric. Europe's watching closely, and they're not standing still. Starting January 2026, the EU's Carbon Border Adjustment Mechanism kicks into high gear, charging importers for every ton of CO2 in steel, cement, and other heavy goods. With carbon prices hovering between 63 and 75, a standard steel slab carries a 130 fee. Canada's counter? Low carbon. X-Carb, steel from Ontario, with just 0.3 tons of CO2 per ton, slashing the EU toll to a discount over 80%. Mexico's playing the same game, with new battery plants in Celaya hitting the EU's 55 kilodegrees CO2 per kilowatt-hour benchmark to dodge tariffs entirely. Prince Rupert's port, 500 nautical miles closer to Asia than any U.S. rival, cuts sailing time by 60 hours, trimming fuel costs and carbon footprints. European buyers are already calling Canadian mills for green steel and Mexican plants for batteries, chasing net zero supply chains that sidestep U.S. harbors. This isn't just about tariffs, it's a tectonic shift in global logistics. The Northern Corridor could redirect billions in trade, leaving U.S. ports and payrolls in the dust. Yale's budget lab ran the numbers. Trump's full tariff package, plus retaliation, could shave $135 billion off U.S. output annually and wipe out 641,000 jobs, mostly in the Midwest where steel and auto parts meet farmland. Factory orders are already thinning, and truck brokers along I-94 report softening rates as shippers eye tariff-free rail routes. Insurance firms are hiking premiums as Ohio logistics parks see vacancy rates climb. The tariff wall, meant to protect American jobs, risks starving the very economy it's supposed to shield. And then there's Boeing. Europe's Rynair waved a match over its $43 billion order for 330 jets, daring Washington to blink. That deal, once a cornerstone of U.S. aerospace, is now a bargaining chip in this trade war. If it collapses, the shockwaves hit Seattle's payrolls and supply chains hard. Canada and Mexico, meanwhile, are pouring cash into their escape hatch. Ottawa's National Trade Corridors Fund is funneling $2.3 billion into Prince Rupert's rail and port grid, while CPKC's single-line track from the Northwest to the Gulf is already cutting transit times. The corridor's not just a rail line, it's a statement. If it hits half its capacity, it could move enough steel and batteries to make Trump's tariffs a $2 trillion own goal. So here's the question: can a single steel rail and a shredded jet deal shake Washington harder than a $2 trillion market wipeout? The next 18 months will tell the tale. If Canada and Mexico pull this off, the U.S. faces a choice: drop the tariffs or watch Detroit's orders vanish to ports it can't tax. The countdown's on, and the first freight train might just speak louder than any speech on Capitol Hill. What's your take? Will America pivot, or will it get left behind as the Northern Corridor rewrites the future of trade?